In this video, we will explain why you should never invest in bank stocks. To some investors, banks may seem like a safe investment that yields good returns. However, this couldn't be further from the truth. Understanding how banks operate can make anyone more cautious about investing in them. So, how does a bank actually work? Banks are essential financial institutions that accept deposits from the public and create credit by providing loans. The entire banking system uniquely relies on trust. When you deposit your money in a bank, you do so believing it will be safe and accessible. To you, having money in your bank account is equivalent to having cash in your wallet. This trust forms the foundation of the whole banking system. Rather than storing all your money in a vault, banks use deposited funds to make loans and buy bonds, retaining only a small fraction as reserve cash. This practice is known as the fractional reserve system. Essentially, this means that banks do not have all the money that has been deposited at any given time. The reason they can still function effectively is because people generally trust that their money is safe. Due to this trust, large-scale withdrawals are rare, allowing banks to meet the usual demand for withdrawals. If everyone demanded their money back simultaneously, the bank wouldn't have enough cash. However, because people don't often withdraw all their money at once, the banking system remains smooth and effective. This widespread confidence is what enables banks to operate, lending out funds and generating more money. Banks work by using your deposits to create credit, loaning out money, and investing, while keeping a smaller percentage available for daily withdrawals. It's a system balanced purely on the trust that your money will be there when you need it. If this belief is lost, the inevitable will happen: a run on the bank, causing any bank to fail. Banks are complex institutions that require exceptional management due to the intricate nature of their operations. They handle vast amounts of data, ensure regulatory compliance, mitigate risks, and maintain liquidity. Compliance with numerous local and international laws is crucial. Failure to comply can lead to hefty fines and damage to reputation. Risk management is another critical aspect, involving credit risk, market risk, and operational risk. Banks rely heavily on technology for their operations, making technical expertise essential. Despite excellent management, banks face challenges such as economic uncertainty, human error, and the rapidly changing financial landscape. Poor decisions can result in financial losses, legal repercussions, and a loss of customer trust. Maintaining trust is pivotal, since the entire system operates based on the belief that money is safe in the bank. You may think that great investors like Warren Buffett hold a large amount of bank shares, but in recent years, his firm has been selling these shares. In 2020, Berkshire Hathaway held stakes in U.S. Bancorp, Wells Fargo, and J.P. Morgan Chase. He exited the J.P. Morgan position that year, closed out the Wells Fargo stake in 2022, and sold his last share of U.S. Bank at the start of 2023. Regarding investing, one of the fundamental principles is to avoid businesses that rely heavily on borrowing to achieve adequate returns on equity. While most companies have some level of debt, they generally don't depend on it for survival and can achieve decent returns even before leveraging their assets. Banks, on the other hand, leverage significantly more than any other business. For example, a bank with a 5% equity-to-assets ratio has leverage of 19 times debt to 1 time equity. The precarious nature of this high leverage means that when things go wrong, the bank can go bust quickly. This isn't unusual. It's the standard banking model. Banks typically earn a small return, around 1 to 2% on their total assets. Since 95% of these assets are funded by depositors and bondholders, the return on equity is significantly higher. A return of $1 on $100 of assets translates to a 20% return on the 5% of equity capital. This is all fine, until something goes wrong. Then, a loss of just 5% of the value of the assets means the shareholders' equity is wiped out. An even more pernicious threat is a bank run. Investors have forgotten about the credit cycle until the 2007 financial crisis, when credit was suddenly withdrawn from banks as well as their customers. Banks can be brought down not just by their own misjudgments, but also by the failings of other banks in the system. The fragility of banks is exemplified by a story from the 1980s when there was nervousness in Hong Kong following the signing of the Joint Declaration regarding the colony's handover to China. Property prices began to collapse, leading banks to accumulate bad debts. During this volatile period, a queue formed as people waited for a bus. When it started to rain, the queue moved under the canopy of a nearby building, which happened to house a local family-controlled bank. Passers-by, seeing the line, assumed there was a problem at the bank. Rumors of a run quickly spread, and by the next day, The bank was besieged by depositors demanding to withdraw their savings. This incident underscores how fragile banks can be. One misinterpretation can trigger panic and cause a bank run. So, why should you never invest in bank stocks? The fragility of banks is illustrated by these examples. The fact that people lining up outside a door can cause a bank to collapse, the potential for bank runs, and the leverage banks hold make them inherently risky. Banks have more leverage and risk than other companies. They are more complex and more economically sensitive than other companies. They are also more vulnerable to the whims and actions of random depositors pulling their money than any other business. Even highly leveraged companies, like those in real estate, don't compare to the complexity and fragility of banks. So why would you invest your money in banks when there are so many other great companies out there? If you're willing to find out what the key characteristics are that super investors seek in stocks, you can try out Wick Academy's investment training. It will teach you everything you need to know about decent investing in the stock market. That's all for today. If you enjoyed the video, leave a like and subscribe to the channel for more.